Hello and welcome to the North Metro SBDC programming.
Good afternoon, everyone. So excited that you've joined us. Hopefully, this is your third session of the wonderful series of Opening Your Business. And as Raul mentioned, sponsored by City of Westminster and North Metro SBDC, of which I am one of the lead consultants. So just to give you a little bit of background, I have over 4 decades of working in the financial services industry. I was a banker, economic developer, and I currently serve as a financial and retirement income planner. So I'm all about money and numbers, and many people think it's a scary topic, but it doesn't have to be. So I am going to cover very general terms, and I apologize if it's too general for some of you, but our whole purpose is this is Business 101. And I want to let you know, starting a business is really like raising a child. You need a community of family and friends. You need a village of city resources and mentors and advisors specializing in different areas of expertise that you might not have. But more importantly, you need people to tell it like it is, not what you want to hear, but how it really works. And the sooner that you can understand the basics of starting a business, running a business, the more confident you will be and better decision making that you'll be able to provide. So whatever your reason is for being part of this series, maybe you hate your current boss, maybe you think your boss is making all these profits, but you really don't understand that they're not. Or maybe you simply have a passion and you've always wanted to be an entrepreneur. It's in your blood, or it's something that you want to take upon yourself and try it. But any successful business owner, you have to have a handle on your finances. So that's what we're going to talk about today. Let us begin. So today's focus on the next slide, Raul. Am I doing it or are you? Thank you. It really is, like I said, getting a handle on your businesses. So we're going to talk about some very basic foundational financial concepts. We're going to learn how your personal finances are so key on your business success. And of course, we're going to give you some sneak peeks on how you can avoid some early pitfalls. Questions, write them down, jot them down. Nothing is off limits. Money is serious stuff. And I want to make sure that you feel comfortable and have a good basic understanding for this series. We do have another series that gets into it at a much more in-depth level with Leading Edge. Is a great program we have, but please jot down your questions. We will leave plenty of time to answer those questions. So let's get into the serious stuff. How many of you have heard about the 5 C's? Anybody? Other than maybe having your keyboard, repeat CCC a couple of times. On a macro level, this is something that you really need to understand especially if you think you might need to borrow money. And this is what bankers look for. This truly is the baseline. And a lot of people think, oh, you can just borrow money or let me get a grant, that it's fairly easy. It's not. But if, again, you're educated and you understand what you're up against on the other side, it could be easy. And planning ahead and taking this class is your first step. So, number one, character. I can't tell you enough how people think, oh, it's not that big a deal. Yes, it really is. It's your credit history, your reputation. We'll get into your FICO score and how that can reflect part of your character. We'll talk about that going forward. Your capacity. Do you have the income to be able to pay your lender back? And that's all lenders want. They're a business like anybody else. And so they lend money, they charge you interest. That's how they pay their expenses. But they're not in the business of taking risks. They want to know that you have the income, whether it's personally or from a business, that you're able to pay them back. And if you have what's called a debt to income ratio, a high debt to income ratio, you have $50,000 in debt and you only make $40,000 a year. That's like excessive debt to income. Just looking on your cash flow, you wouldn't be able to pay it back. So your capacity, your ability to pay them back. And then, of course, capital. What's your skin in the game? Let's say you have $1,000. You've saved it, you've worked hard for it, and you want to borrow. Your business is going to cost $100,000. Do you think the lender's going to look at $1,000 against $100,000? Is that enough skin in the game? It used to be, depending. I'm just going to give some more in-depth. SBA loans, you could put in 5%. Now, based on some conditions, it's 10%. If you go to a commercial bank and want to borrow money, they're looking at 20 to 25% of your skin in the game. So if you want to borrow, you need $100,000, 25%, you're looking at $25,000. You need to have skin in the game. It doesn't always have to be cash. It could be maybe you have equipment that you purchased 3-4 years ago and it's paid for. That's skin in the game. You have an asset that's part of the cost of running your business. And of course, collateral. Not all loans, not all lenders require collateral, but it gives them that comfort, a little bit less risk in case, what? If you're not able to pay them back. Keep that in mind. The lenders just want to get paid back. So God forbid, the business isn't going well, you didn't plan very well, and whatever collateral you put up, the way the lender's going to get paid back is they're going to have to repossess, foreclose. They're going to take ownership of that collateral and sell it. And that's how the lender gets paid back. So, and lenders don't always and can't always tell you what you have to offer for collateral. You have to offer. So maybe it is equipment. Hopefully it's not your home, but maybe that's your biggest asset you have. Maybe it's a life insurance policy. Depending, you offer, and hopefully that will encourage the lender to possibly work better with you to provide that loan. The last one, conditions. How many of you casually watch the news or just in your own day-to-day life know that the economy is a little bit on easy ends? have you heard of something called tariffs, aka taxes? Those are extra costs. We are much more in a global economy than we were before technology and the internet in the 80s. But now we are very hyper in a global economy. And even not just the overall economy, but maybe industry. Let's just pretend, hopefully everybody will get this analogy. Let's say you want to open up a Blockbuster video store. And you think everybody's going to come in and rent your videos because you've been living in a cave or under a rock. And you don't know that technology exists, like Netflix or Hulu or Disney streaming or anything else. That industry went from quick growth to death. And I think everybody knows that. And so you, the business owner, part of your research and understanding what is your product or service, what are the economic conditions that you hope to have a successful business? This is all your pre-planning, your ability to understand your industry, to understand your product and service. Are you able to create revenue with that product or service? And character-wise, even if you have the money, are you going to pay them back? So the lending environment right now, banks change their credit criteria. The SBA just announced they've tightened their credit criteria as of June 1st. Not going to go into the details, but the bigger world of lenders have tightened. And so maybe in the past, they would say, this looks good. We've checked all the boxes, but we feel comfortable. Well, guess what? In today's environment, they're not feeling so comfortable because it's a lot of unknown. And you, as the business owner, shouldn't like the unknown any more than a lender does. So you can then win, and every day you will have decisions to make. Do you feel comfortable and confident that it's the right decision for your business? Let's look at the next level within credit. And there's something called a personal credit score, otherwise known as FICO. Many of you probably understand FICO, but you probably don't really know what it is. There was a company called Fair Isaac Corporation who created this credit scoring software that basically assesses your creditworthiness. So, creditworthiness in general is, can you personally pay your bills over a 2-year cycle of the ups and downs of life? We get raises, we get laid off, we take a pay cut, we get sick or hurt and can't work. Will you still pay back your credit, your bills? And generally it's looked at a 2-year time frame. So if you're just starting out, you're young, maybe you just graduated from high school or college, and you just know you want to be an entrepreneur, you will have difficulty if, one, you don't have established credit of 2 years or more, which also falls into play the same definition of 2 years as a startup business, because they want to see your track record. And a lot of traditional lenders won't even lend to startup businesses. That's where the SBA, some other nonprofit lenders can help if you have a good credit score, if you have some skin in the game, if you have income other than what your new business is going to provide. Will you have income from other sources, or maybe you are more than a family of one? Maybe you have a spouse that's creating income. So all of those things, 2 years is very much a magic number when it comes to credit, whether it's personal finances or even your business finances. Also, debt obligations. I already talked about, do you have way more debt than what your income can pay back? One of the things to help with your debt obligations to increase a credit score, which, by the way, nonprofits, SBAs, generally a minimum FICO score is 620. I think it now might be 650. So if you have a personal FICO score of less than 650, I would say you definitely need to work on your personal finances. Don't waste your time. Don't waste the lender's time, because if it's under 650, chances are it's an automatic no. They won't even really talk to you. But one of the ways to increase your credit score is if you have more than 70% borrowed, a 70% or higher balance of your credit limit, bringing it under that 70% is one of the easiest ways to increase your credit score. So easy numbers. You have $1,000 Visa. Your balance is $780. In order to have a positive impact to raise your credit score, you need to bring that to $699 or less. And that comes down to your personal finances. How much money now are you bringing in income? And how much are you paying back? Are you simply only paying that minimum? Well, that minimum might not even cover barely the interest, let alone get your principal reduced. So there's some other things with your credit score, and you can get now, fortunately, a copy of your credit score for free, either from the 3 major reporting entities: Experian, Equifax, and TransUnion. You can Google any of the 3 of them, and it'll tell you how you can get your credit score if you're not aware. And also, it's important to check to make sure there's nothing derogatory, negative, something that really isn't yours because you're a junior and maybe it's your dad's debt, but it's showing up on yours. So those, similar names, it's great. Family, you have my same name, but boy, can it be complicated when it comes to looking at your credit. The other thing with your personal finances, your personal savings, and it says as a business backup, you should actually have your own personal savings for your personal cash flow situation as a backup. We've all had you ran over a tire with your car and you ran over a nail with your car and now you need new tires. And maybe you're maxed on your credit card, or maybe you don't have a credit card. You need your savings in order to get new tires. In personal savings, you should have 3 to 6 months emergency fund. In the business world, that backup savings is called a contingency fund. It's really contingency on both. What if? And we all know stuff happens in life. How are you going to pay for whatever it is? Where's your cash flow to come in that emergency when you need to be able to pay something. The stronger your personal financial health, the better you will have chances of getting a business loan, of having business success, because you have that strength of assets, of cash, of savings in order to help and funnel all your time and energy in the business and not worry about all of your business problems and challenges. So credit, very important. So if we go, I'll just answer this one real quick. Contingency fund for your business is more covering, and it depends, I hate to say, but what your monthly business operating expenses are. So, if again, your cash flow coming in and it's a lump sum, or you have some one-time expenses, it all depends. And I'm happy to meet with people one-on-one to kind of discuss some of this, but personal 3 to 6 months of savings, business, hate to say, but it depends. But it's still having money in the background that you can fall back on. So when you're looking at, on our next slide, we're talking about managing your personal debt and savings. This is just your personal life. And I want to ask all of you first is, do you have a personal spending plan? I didn't say budget. Too many people think budgets are restrictive. I can't spend money. You will spend your money, whether it's tomorrow, next month, 30 years from now, or 50 years from now. You will spend it. But what are your goals and priorities? Are you really spending money personally against those goals and priorities? And not just, you don't have money today, so let's just put it on a credit card and have these high interest bills. So you really should start, focus on your personal spending plan. What are your goals and priorities? Because your business is just another goal and priority. And often too many business owners put all of their efforts towards their business and kind of forget about their personal. Well, guess what? They go hand in hand. But ways that you can kind of reduce and manage your debt and your savings. One, reduce the high interest debt before you even launch your business. Maybe you can get a consolidation loan. Maybe in the short term, again, depending on your revenue, your income, pay some of that down, because you might not have any profits. You might not have any income for your business for 3 months, 6 months. And so how are you going to still pay back that debt on a personal side? Because as I mentioned earlier, if your personal credit, your personal debt is going out the roof, do you really think as a business owner, your business is miraculously going to hire and create money? No, it doesn't. If anything, it's going to suck out money from your personal savings and your personal cash flow. And this is where building an emergency fund, as I mentioned, 3 to 6 months. Now, if you don't have any debt, maybe you don't need to have 3 to 6 months, maybe 2 or 3. because you have a huge savings that you could fall back on, or you have, as I mentioned, you're a family of one or more, and there's another source of income coming into your family. On the flip side, you might have an extreme amount of debt, spouse, but the spouse does not bring in another source of income. And you also are taking care of your elderly parents. And so maybe you need 6 to 9 months of an emergency fund. Having that cushion just relieves stress and really allows you to better focus on your business when you need to. But I will say, early on, whatever you have personal, keep your business finances separate. As Jesse mentioned in the first session, for those of you who participated, he started out with a lot of the legal requirements and how do you register and all of those things. The two foundations of any business are your legal, and guess what we're talking about today? Your finances. And how, because your legal structure is what allows you to, guess what? Fill out your tax return based on your finances of revenue, expenses, and profit. So depending if you're a sole proprietor, an LLC, a subchapter S, all of those that Jesse talked about, that will definitely influence your financial statements for a business. So even if you're really starting out simple, open up another checking account, open up another savings account, even if it's in your own name and not your business name. Maybe you're thinking you're going to start your business next summer, and maybe you want $100 a month from your checking account or savings account. You're going to automatically transfer into this separate account that's just for your business. Keep it separate. Keep your mind separate. There's you as the human, and there's you as a business entity. Definitely, if you can, also part of your contingency fund, maybe you have a personal savings for the family, and you also have another savings personal as a backup to your business savings contingency fund. The more you have up front, the more options you will have when things get tough, because they might. But again, having your spending plan together, organized, you know where you're at personally, and then you can start on your business, and you want to keep them separate. So let's get into some basic, boring, everyday terms. Hopefully some of you are familiar with these. I think everybody understands the world of profit. But in a business, you basically will have 3 different financial statements that will provide you information. As I always mention, your numbers will talk to you in a pretty simple sense. The first one, let's mention, is an income statement. You can equate it to your own personal. You have income minus expenses. What's left over, you might not think of as profit, but maybe it can go into your savings, or it's for a future expense. But revenue is any sorts of income that comes into your business. It could be one source of revenue. You sell a product or a service. You charge $100 an hour. You have 10 customers. So you will have revenue of $1,000. That's just revenue. Or maybe you have more than one source of revenue. which is always helpful. You sell your product or service. Then you also have a membership subscription. So revenue comes in on a steady basis. Maybe you also get a contract with a school district or a city or a large business, or you have a landscape business and you have a contract with 10 different HOAs. That's 10 different revenue sources, all revenue income. Then, of course, people think, woohoo, profit, whatever's left over, that's my profit. Well, on paper, it's profit. And we're going to get into another statement in a few minutes that I think really is almost more important, because not to get too detailed into accounting, there are some expenses that aren't actually cash expenses. So, but they show up on paper, so it can be deceiving. But revenue, you brought in $10,000, you had $8,000 of expenses. So we think, woohoo, $2,000 is my profit. Does everybody get that? I can go into some more details later. But let's talk about gross margin. And not everybody will have this. If you have a service, you generally won't have gross margin, because it's all about the cost of the good that you sold. So if you're selling this pen, you still have the same $10,000 in profit, in revenue. So sorry. But let's say it costs you $6,000 just to buy this from some hopefully domestic company or maybe overseas. So now you have $10,000 revenue, but it cost you $6,000. So now your gross margin is really only $4,000, because the money that came in, boom, it went out because you had to pay for your product. Now your gross margin is only $4,000. But guess what? You still have utilities to pay for, maybe staff, maybe a website, maybe taxes, insurance. And so you have $4,000 of a gross margin. But let's say you have expenses of $5,000. So now what's your profit? 4 minus 5, guess what? That's a loss. You don't have a profit. You have a net loss of $1,000. And when you start a business, the SBDC has many classes to help you project at what point will you cover those costs? When will you have enough revenue to have a net profit? And this is where maybe 3 months, 6 months, most business owners cannot have a business and still have losses after a 1 year. I mean, how can you survive? You're going to have to take all your money from the business savings, your personal savings, just to break even. Break even means 10,000 minus 6 gives you 4,000. And let's say your overhead, insurance, utilities, wages is also 4,000. So what you have left over is 0. That's break even, which is okay. It's better than a loss. So think of your own paycheck. You bring in $4,000 a month. You pay your rent or mortgage, utilities, your credit card, which is also $4,000 a month. You have 0 left over. Not going to be able to fund any savings any contingency fund, any emergency fund, but you're not negative. You're not in the hole. Net margin, if you can see, is net profit as a percentage of revenue. And this is where I counsel business owners who are starting out. If you're using an Excel spreadsheet, have a column in there that shows the percentage. The percentage, I find more often than not, is what's going to visually, you will see and go, oh my goodness, that percentage is going the wrong way. So anyway, gross margin, you subtract out all your additional expenses, then your net margin or your net profit. And understanding and having it by percentage can be really helpful. And we get into that more in the leading edge class. Let's look at the bottom one, the balance sheet. You have assets. You have a home, you have a car, maybe you have a 401k, maybe you have a collection that has value. Those are assets. That's what you own. Minus liabilities, that's your debt. And it equals net worth. Same thing with a balance sheet for a business. Maybe you have cash, you have equipment, you have inventory, but all of that inventory you put on a credit card, you put on a line of credit. So let me give you an example. And I want you to think about this, and I will tell you the answer at the end. Let's say you have assets as a business or personal of $1 million, but you have debt of 900,000. What is your net worth? It's 100,000. And often people think, woohoo, I have $1 million. Look at me. Aren't I good? Aren't I successful? But are you really? If your net worth is only 100,000. Let's compare it to another business owner that has $300,000 in assets, but they have zero debt. What is their net worth? 300,000. Do you want to be the person, the business owner with $1 million, woohoo, and 900,000 in debt that you got to figure out how to pay it back, who's worth 100,000? Or do you want to be a business owner person with 300,000? Which one do you think the lender, the banker, is more apt to lend to? The $1 million in assets or the $300 million in assets? ... less debt. It's going to be the person with no debt and $300,000 net worth. You can do this for your own personal, because a lender, a banker, an investor, a business partner, what is your personal assets? What do you own? What are your assets minus your liabilities? What maybe do you need to work on to strengthen that? Now, cash flow. Do you see that one in the middle? It's not hiding for a reason. It's because it works between your income statement and your balance sheet. Cash flow. It's flowing in and it's flowing out. Your paycheck comes in and you spend it and it goes out. A business, money comes in, but how you manage, how you use that money, how do you spend it? Do you expand too quickly and spend all that money? And then what do you have left for those what ifs? Or do you use it only enough conservatively and you put money aside for future expansion. Unfortunately, I have seen clients as a banker and even currently in financial planning where business owners expanded too quickly and failed because the money coming in wasn't fast enough for the money that had to go out. You think of your heart, the blood comes in and the blood goes out. If you have a blockage and you can, and the blood goes in, but it doesn't come back out, or vice versa, it doesn't even come in, what happens? Cash flow strains. You got to be able to manage the cash flow. The income statement is a point in time. It just tells you what's coming in, where's it, and it gives you that net profit or net loss. The balance sheet, what are your assets? What are minus your liabilities, point in time. But cash flow is always ongoing all the time. Personal, business. You have to be able to manage your cash flow. All right. I'm happy to answer more questions. Those are some basic financial terms you really should know. On the next, we have an example of a source and use statement. Here, starting your business. What is your investment? If you have a shortfall because you're using your capital, maybe for real estate or some tenant improvements, you need new carpeting or painting for the place you're renting, you need inventory. That difference is where you either need a bank loan or maybe family or friends or from your suppliers. Some cities have revolving loan funds, all sorts of things to help you get started with your business. Where are the sources coming from in order for you to have enough for the uses of your business? If you start underfunded from the get-go, or you have too many personal debts that are putting strain on your cash flow, it's not going to be a happy startup business. Make sure you have enough funds up front to start your business, because we know in everyday personal life, stuff happens. Well, guess what? In business, times 10. So think about that. So let's talk a little bit on the next screen. When you're looking at your financial statements, what are some one-time startup costs versus ongoing expenses? And the ongoing expenses is what's key for your cash flow, that you have enough income coming in order to pay the rent, the payroll, buy more inventory, have your marketing. But one-time startup costs, as Jesse mentioned, your licensing, whatever permits, if you have a cottage business in food, you have to take your upfront food handling class and get the license. Maybe you need to buy some equipment. Do you buy it? Do you lease it? What is the strain of that one-time cost? If the equipment costs $10,000, do you have $10,000? But is that the best use of your $10,000? Or maybe you lease it and only pay $400 a month, and you put a down payment of $3,000. So 10 minus 3, you still have $7,000 left for your contingency fund. What if you get a lemon piece of equipment? What if the equipment you bought isn't what really going to solve your problem? You need a different piece of equipment. A lot of that can be solved by pre-planning and looking into different vendors. really looking at what is the need that you have in that equipment. Website development. You know, before 1982, 84, people didn't have websites, right? You had signs, you printed menus, you printed flyers, postcards. Now website, that's standard. Are you going to accept payment on your website? What software are you using? A lot of that are those upfront one-time costs. We can talk more depending on your industry. Hopefully the one-time startup costs, you have enough money to actually pay for those. So then you have less stress on the cash flow you may or may not have for 3 months, 6 months to be able to pay for your ongoing expenses. All right. Next. Next slide. Hopefully.
All right, we have a question.
Okay.
So Belinda's asking, I think this is in regards to the cash flow, and knowing when to sort of grow. Our contracts aren't yet consistent. What indicators would you use to feel secure in making investments or taking on new obligations?
Well, one, part of your projections, and actually I think that's part of the next slide, perhaps, with your budget and your revenue, is how comfortable are you in spending more money? You know, it's time decisions. One, as much as I like to think I'm the most important person in my client's life, I will tell you, your accountant, your CPA, what do the numbers say? Build in some of those what ifs. And it really depends on your industry. If your contracts aren't consistent, that would make me uneasy. But it depends on your personal situation. Do you have a lot of debt? Do you have a lot of expenses to cover if you start spending money on your business and that revenue doesn't come in? Those are probably some things we can talk about one-on-one, but you know, so many businesses, different industries, different financial situations, both personally and business, on your cash flow. Are you a risk taker? Are you not? What are other extenuating circumstances that you might win or maybe not? I highly recommend you have projections that are conservative. Anybody can come up with revenue projections and think everybody in the world's going to buy your product and you're going to make $1 million in the first 6 months. Anybody can dream. And I hope you do. But the reality is, what if they don't? So with status quo of, let's just say 5 contracts a month, and look at your fixed expenses, look at your variable expenses. Actually, can we go to the next slide, Raul? Because this kind of fits right in with this, with your budget and your projections. What are those monthly expenses? And will 5 contracts cover it? Or having 5 contracts steady across the board, you might not turn a profit until month 7. Is that okay for you? Maybe not. What if you only get 2 contracts a month? Now let's look at your expenses. Fixed and variable. At what point do you make a profit? Do you have positive cash flow? And so be conservative. Your lender will like it. Your heart will like it. Your spouse will like it. You can always have more, but you have to know what your fixed and variable costs are in running your business. And in our classes, we have examples. I kind of showed it earlier with your source and use statement. What are some of those expenses? And how much control do you have over those? Start with expenses. Do a quick brain dump. If I open business ABC, what do I know I'm absolutely going to have every month? And then back in, how many customers, how many clients, contracts do I need to get to break even? Your expenses are $3,000 a month. You need to bring in $3,000 minimum to break even for a zero profit. Or do you have $7,000 in expenses? Now you need 10 customers a month just to break even. Or this is where in marketing, and you analyze your industry, are you only charging $100 an hour, but everybody else is charging $130? Well, maybe you're not pricing your service or your product competitively. On the flip side, let's say everybody's charging $100 and you're charging $130. That can be okay if you are adding value, additional services, a specialty item that nobody can get anywhere else. And so part of pricing your product, do you need more marketing? Do you need to be marketing in your niche market, not just to everybody in the world? Fish won't buy, that's a bad example, won't buy a pen because they don't have hands and they don't write. You know, who is your actual market you're going to sell to? What makes you better than your competition? But start out, what are those expenses? As I mentioned, you're forecasting your revenue. Plan every day, cross fingers. We should be able to make it work at 5 contracts a month, 5 clients a day. But try to plan and manage with only 2 a day, 2 a month. You can always do lots of things when you have 10 because you'll have really good positive cash flow. There's a lot of different spreadsheets, apps. Quick Excel is real easy. You can also just use a paper and pencil and write it down. As long as you know math, plus, minus, that'll give it to you. QuickBooks is a very popular accounting software. There's Wave. LivePlan is a new software that the Colorado Office of Economic Development and the SBDCs have contracted with. And LivePlan is a strategic planning software that has a fabulous financial accounting upload that you can write a business plan. You can look at research and data. You can look at marketing, and you can have your accounting software with different scenarios. What does 5 a month look like versus 2 a month versus 10 a month? What if I charge $100? What if I charge $130? All of those kind of what ifs. Lots of tools out there, but it still starts with your basic financials. How much money do you have? What are you covering personally? How much can you afford to put into your business? And make sure you update monthly what your spending plan is, personally and also business. And this is one thing that I always recommend to people. You can dream, you can be creative, And this is especially hard with people in the creative industry, or the social services like therapists or artists, photographers, people who aren't generally adept with numbers. They know they're there, but they don't like them. But 1 day a week, morning, afternoon, you pick the time. You need to have a meeting with yourself as a business owner looking at your financials. We're not thinking about what colors of our website we're going to have. We're not going to think about, what new groups we can market to. This is called numbers. Revenue, expenses, what's my cash flow? Is it coming in or is it going out too quickly? Do I need to get some sort of backup from savings or maybe a line of credit from a bank or a credit union or wherever? But promise yourself, just even if for the first 3 weeks, you just sit there and go, okay, what do I have to do again? Let's see, revenue. And you think, even if you're not overly productive, get in the habit of having a board meeting with yourself, with you and your partner, whomever. You have to do that and be aware of your financials at all times. Pitfalls. Some of the ones that you really want to avoid. What's that third word up there? Avoid common cash flow pitfalls. You don't want to overestimate revenue and you don't want to underestimate expenses. Money coming in has to be more than money going out, or at least short term, and it's supplemented with savings or a loan or something, but you still got to pay it back. Make sure that if you have receivables, so receivables are a term used when someone has a business that does not have cash sales. If you're selling your product at a farmer's market, here's your product, the person buys it, they give you $10, that's cash. But let's say you have services or even other products you're selling to a business, but the terms, you're not requiring them to pay up front, cash on delivery, COD. You're going to let them pay you in 30 days. You sell it on day 1, day 2 through 29, it's a receivable. Make sure you count, because guess what? Stuff happens in life. Just because the business is supposed to pay you on day 30, maybe they don't. Maybe they don't pay you for 45 days. Well, here comes back to your cash flow sources and uses. You need that source coming in on day 30 because guess what? You have uses on the first of the month to pay. So you need to be able to buffer in time just in case you have slow payments. If you have a contract with the government, large companies, they tell you up front, they will pay you in 60 days. That's your issue of your source and your use of when you get that money. You need to plan for it. Depending on your situation with a bookkeeper, an accountant, but you really should monitor your accounts receivable. Because if you think that money's going to just show up and come in and it doesn't, there's regulations as to how you can go back against someone to get that money collected. How many notices you have to send? Do you have to take them to small claims court to get your money back? So make sure you monitor. Make sure you understand your numbers and you watch them. We talked about keeping business and personal accounts separate. And then cash flow. There's a whole new world out there called seasonality. You're a wedding planner. You're a florist. Mother's Day. Woohoo! What happens in July? Do people send flowers for 4th of July? Probably not. But you have weddings. But what happens in October, November? Not much. So seasonality, you're going to have huge sources coming in, a lot of cash flow coming in during, let's say you're renting out a campground, May to September, because all the kids and families, they don't take vacations after September. They're in school. May through September is when you get all your money. Woohoo! And then you use that money. You use it from October until next April. Where does that money come from when you don't have any cash flow coming in? So lenders, there's different types of bank credit. There's things that you can do. It takes planning, and it also has that contingency fund. What if an unexpected expense comes in and you're out of season and there's no revenue coming in? So this is all about planning ahead and thinking about it. Use your village, use your community, use your mentors. The SBDC, City of Westminster can help you understand, what are some of those things that you need. So recap, I wanted to give plenty of time for questions. Really having clarity, understanding your numbers, understanding your market, your industry, it's going to give you confidence. So when you make those decisions, it's a lot easier. Business owners will make decisions every single day, but I hope and I encourage you, think about the long-term macro aspect to your business. Now, if you're starting a business and you think, I'm not sure that I want to do this forever, maybe just for the next 5 years, we'll see what happens. That's very different than you starting a business and you want this to be a legacy for your children. Making decisions with the long-term big picture is definitely going to help you with those short little decisions, because they will be different depending on where your focus is on your business length of time and how it will survive. There I said, get your help, accountants, advisors, mentors. We are here to help. And you can, and a lot of people think they know it all and want to do it. Knock yourself out, but no, it's a lot easier, less stressful, more enjoyable when you have a community, a village, and friends and family to help you. Start smart, stay steady, and grow wisely. Thank you to City of Westminster, SBDC. I hope you all enjoyed this presentation. And like I said, no questions are off limit. So who's got questions?
We do have one question in the chat. Connor is asking, how old do you have to be to start establishing credit?
Legally, 18, because any credit, there's a contract. You might not realize it, but when you open a credit card, there's something called terms and conditions. And it'll always say in there, at least in America, age 18 is where you are able to sign a contract. Sometimes parents will get a credit card and can add someone under 18 as an authorized user, but they're not liable for that debt. They're not liable for that credit. And for those of you who are parents, I would recommend you really have some good conversations and think twice before just actually automatically giving your child access. I've seen it be quite painful for many people. That's on the personal side. That's your parental skills. And anyway, age 18 for contracts. What other questions, thoughts? What needs, maybe what terms need to be clarified?
Somebody's got their hand up. Belinda, go ahead.
Looks like
Thank you. So I have
Belinda.
QuickBooks and I really want to understand our finances very, very well. So I don't mind getting in there and, putting in the bills and reconciling and doing all of those things. Right now, I don't really trust QuickBooks to run reports because I'm still learning those things and getting my processes really consistent. And a frustration that I have is that when I go to learn more about how to use the QuickBooks system, there's tons of stuff on YouTube, but I often feel like I waste a lot of time kind of learning things I don't need. And it's like I'm looking for a resource that can teach me from like do this and do like QuickBooks for Dummies. Maybe I just need to go get that book, But what would you recommend to really teach yourself bookkeeping from the very most basic level so you can just understand it really thoroughly?
Yes, great question. And I have a great answer for you. One of the
Awesome.
consultants that we have at North Metro is an accountant. She works for an engineering firm, I believe. But even though I have an accounting degree, I don't work with QuickBooks and debits and credits and things on a regular basis. I'm much more macro strategic. But Carol Johnson is one of our consultants. Now, Raul, I don't think Carol, is she a lead consultant or is she one of the specialists?
She is on the lead consultants.
She
side.
is. Okay.
Yes.
So generally, if anybody wants to just pick our brain, we have about 6 lead consultants with pretty in-depth backgrounds. Some of us specialize in some areas, some specialize in other. But the good news is we have additional specialists that any of the lead consultants, based on your conversation, can refer you to them for free. Even talking to any of the lead consultants for free. So if you want to talk with me, just general picture, big picture, what about? I grew up in family business. I've had my own. I'm currently self-employed. Been there, done that, still doing it. I get you. But I also can refer people to marketing. We have 3 attorneys. We have a research and data specialist. We have all sorts. So whether it's me or if you want to sign up with Carol directly, I'm happy to refer you to her. And she knows QuickBooks and can give you all sorts of ins and outs. So hopefully that answers your question, Belinda, and hopefully it gave some extra insight to all the other participants.
Yeah, thank you so much.
Any other questions? It's a great opportunity to clarify concepts. If there's a definition you're sure about, anything to do with the financial side of business. Navina does have a question in the chat. Once credit card's approved, how much time to build the credit score of an individual?
So I'm going to ask the audience. Anybody want to talk about what the time frame is to have established so-called credit?
We've got 6
2 years.
months,
That's
2
right.
years.
Belinda gets the fabulous prize. Now, some lenders might, depending on your personal net worth or what have you, I I know I was in my 20s and my mom in her 50s back then, you know, didn't need credit, didn't have credit. The business had it, had cash, didn't need it. So it depends. I will say if someone has not yet established credit, retail credit cards or stores, Old Navy, Kohl's, I don't know. I think Best Buy is a little bit more stringent, but keep in mind, you need to have an income because they're not going to give you credit if you don't have an income to pay them back. So, I know my youngest daughter who just got out of college, it took her a couple of years and now she's established herself, but starting with a retail store, I don't know if Ulta has one or but anyway, once you get one and let me share this with credit. My oldest daughter, this was kind of embarrassing that she didn't know this, that I didn't tell her, or she didn't listen. We'll go with that. When you get a credit card and you charge something, wait for the statement before you make your payment, whether it's minimum payment or you pay it off. But don't go on day one and charge something for $100 and then 4 days later pay that $100, because guess what? Credit is over time. She only had it for 4 days. You need to have at least a 30-day cycle or the statement cycle that they had you as a receivable because you didn't pay cash for it. Okay, so make sure you wait for the statement, then hopefully you pay it off, charge some more, wait for the statement, and then pay it again. But credit is all about the worthiness and the risk or not risk that a company would issue credit for you to what? Pay them back. And generally it's over a 2-year time period through the ups and downs of life that you still have the character, the capacity to be able to pay them back. And that's basically how credit works. And your FICO score is also going to show the payments of up and down. You generally will start with a credit score in the 500s. I don't even know what the minimum is, if it's maybe 500. And so it will, over time, you will get from 500 to 550 to 590 over time as these companies report your payment history. And then you'll get to 620 and 630. 650 is often a minimum for business lending. But once you get a retail store, somebody somewhere, because you have a job more than a month, maybe you have a job for 2 years or 4 years, and you make this amount of, basically on the application, if you look at them, what's your income? What's your rent? And they figure out if you have any money left over to pay them back. Another way to establish credit, if someone has had difficulty in the past and has it very negative, often a bank or a credit card company like Visa, MasterCard will allow you to have a CD for $500. You put in the cash and the bank will use it as collateral and then give you an equal $500 credit limit. Or you can offer $1,000 of your money as collateral in a savings account. and they will then give you $1,000 credit limit. But hopefully you only have to worry about the positive side of things and not about repairing credit. If you find yourself in a difficult situation and you just can't make those minimum payments because the credit payment required is just so high, there are nonprofits out there that can help you. If something happened in your situation, you lost your job, you want to pay them back, you just can't pay them that same amount. I highly recommend do not go after some of these fee-for-service companies. They say they're going to help you. They say they're going to wipe it all out. You're just pushing the can down the road. There's nonprofit. I've referred some people to some. They've been able to help, and they're able to still keep their credit in a good position and on the road to recovery. Any other questions? This is the first time that we've offered this intro course, and really pleased that City of Westminster, can see a lot of their residents want to start businesses and they just need some basic help. So I personally would love any feedback, good, bad, otherwise. I'm a big girl and I really want this to be helpful to you. And so really welcome any feedback, either to Raul or myself or in the chat. We really want this to be helpful for all of the City of Westminster residents and SBDC clients. So somebody else must have some question. Send a message to Raul and he can ask it anonymously if somebody's shy.
Yeah, we're here. And just to reiterate what Karen was saying, I really want to point towards the one-on-one advising. It's free for the life of you being in business and being a Colorado business. So if you are starting a business or have a business, take advantage of the SBDC's free one-on-one advising, because they're here to help. They have a tremendous amount of experience and knowledge, these different advisors, Karen in the financial side, and we have marketing specialists, we have accounting specialists, et cetera, et cetera. So thank you again to Karen. Thank you to the City of Westminster and Shelby Wood. And thank you all for being here. And I will be sending this out in a follow-up email. We'll see you on the next one.
Good luck, everyone.